Jason, we recently released a video that we recorded way back in February. And when we released it, everyone was like, hey, you guys didn't mention anything about Liberation Day. So here we are circling back. It is April 29th, Tuesday. This is our regular recording time. It's good to see you, man.
Good to see you too.
We just got back from a trip together overseas. That was a really fantastic time.
Yeah, we both survived, and
we had our spouses with us, so it was a good time, man. But Tuesday, April 29th, post-Liberation Day, do you feel liberated?
I feel so free and liberated. And so happy to talk about this topic. Obviously, we're going to keep it on the finances.
Yeah.
But there's a lot to talk about there. And we sure did get a lot of comments on our last video about like, oh, I'm so glad you said what day you recorded this because, yeah, a lot's happened. We can't wait to hear from you about it. So here we are, just days after releasing that last video recording, and hopefully we can touch on all the things people wanted to ask, but I'm sure they will let us know all the ways that we failed to meet their expectations, and that's okay. And this is bro talk, which apparently they also want.
Yeah, I mean, I was glad to have that confirmation because I mean that's kind of why we started this podcast, so you and I could just talk to each other and reconnect. We talked over our vacation together about how, we saw this channel moving forward and what we were going to do, because we had taken a pretty big break. And, I think that was pushed maybe more by me than you. And we kind of circled back to this idea that we want to keep going. We want to keep documenting the journey. This is a big transition point for Laura and I. And, I'm sure as people are getting ready to fire themselves, this is, real life sequence risk right here playing out. And I know when you retired in 2020, COVID hit right away, right?
Yeah.
So you went through a similar kind of pretty dramatic market downturn right at that point. And actually now the market has recovered some, and so lots of things to think about here. But I've been hearing from people who are saying on Reddit and elsewhere in our comments section, like, hey, I was getting ready to fire this year, but I think I'm putting it off. So what would you say to that person?
Yeah, I mean, I would definitely say that they're not alone in having those thoughts, and I don't even think it's necessarily wrong to have those thoughts and be, kind of constructively looking at your portfolio. I've had this conversation with a good friend of mine who shares your first name about he was planning on stepping out in March, I believe, of this year, and now it is next year. I think a full year out, if I'm not mistaken, if not longer. And I would say I get it, but I would also say, hold tight. It's going to be okay. Markets are up 7 or 8 years out of 10 in aggregate. Yes, we're going through something right now, and the churn's going to continue probably for the foreseeable future. Both of us have really crappy crystal balls, but I think it's safe to say volatility is probably going to be the name of the game for a bit. And but on the same note, that diligence that people have in doing the right things and thinking about their saving and thinking about their spending is just going to make you have that much better of a plan. So it's, reassurance is mostly for me about just kind of reminding people they have good plans, they're taking smart decisions. And of course, in some respects, it's a lot less scary to be in that position than to be, retiring at the top of the market when it comes to that kind of sequence risk hit. I don't know how much what did I miss there? I'm sure I missed plenty.
Well, it makes me wonder when I hear about people doing the one more year, and I was certainly guilty of this too. If I look back at 2022 and market is sliding, I was reallocating my portfolio. I'm like, oh geez, the number gets further and further away with every investment that I make. And I guess the question is, well, why the one more year? Is it because the portfolio wasn't allocated in a way that market correction made the number that much further away? In other words, did you bake too much volatility and risk into your portfolio more than you could withstand? Do you have any sense for what it was for that person?
For that person, they already have a decent bond allocation. I think it was, but I think it's more just about comfort level, because like you and I have discussed many times, this is, for most of us listening to this show, there's somebody else in your life, whether it's a partner, a spouse, a parent, somebody else you're sharing your life and potentially your finances with, that you're coming to a plan together and operating it not just in a vacuum. And in that case, I know their spouse wants more confidence and more cushion, if you will, than maybe he would be comfortable with.
Okay.
And that's perfectly okay, because they've decided as a team their number's going to be here, even if their true financial independence number, as we would measure it, is lower. They're going to go higher. And so he likes his job. He's on a good team. He's in a fortunate position that his the risk of him losing his job is, as far as he can tell, quite low. So he's not complaining. But I think it is a different case for some people, at least as evidenced by Reddit. Thankfully, I don't see this as much in our community, for example, on YouTube or in the Discord. But there are people who are still 100% equities.
Yes.
Who are now much more concerned, because they're like, hey, man, year to date, SPX is down 6%. Like, that's a lot.
Yeah.
And it's down more than that if you roll it back a little more. So those people maybe have thought about volatility a little different, and maybe they're really counting on some of those who are out there saying, you know what, 100% equities, that might be okay. Even though obviously that's not, I think, what the majority of people think. It's not what you and I think. So you're right to bring that up.
Yeah, and I mean, there is a lot of content out there. Like Ben Felix released a video recently talking about, super equity heavy portfolios. I don't know, 100% equity portfolios. And I'm like, ooh, that gives me pause. And I mean, I think we've acknowledged there's so much uncertainty around the economy right now. Yeah. And I want to acknowledge, lots of hardship and people going through very difficult things. We have the privilege of talking about this. You are entering year 6, right, of retirement?
Yeah, pretty soon. A couple months, it'll be in year 6.
Yeah, and we hit our FIRE number about this time last year. And so we ended up saving, a buffer, because we felt similarly. We knew we were at the top of the market. Things felt frothy. I didn't want to retire right when I hit that number and, not have any kind of buffer on top of that. And so, after acknowledging that, I mean, I do want to kind of check in and say, how are we feeling right now? Have you looked at your portfolio?
Yeah, great question. So I don't normally look at my main buy and hold portfolio until the end of every month, and that's when I do my safe withdrawal rate calculation, which I'm sure we're going to talk about here. Yeah. But I did check it a day early today, and I also looked at my previous net worth statements, because just like you, quarterly, I do a full roll-up, and I looked at it, and I found my all-time high at the quarterly level was October of last year. Probably the same for you, although you're contributing, so it may be a little different.
Yeah, it was this year.
And now, when I look at where we are relative to that, I'm down about 3.5%, and that's net of withdrawals. And so, honestly, that I was saying this right before we started recording, that gave me a little more confidence than I thought it would, because my sense is, when we think about things in an S&P standpoint, well, that's down 6%. But then, I did a little more digging, and I'm like, well, my international equity ETF is up 9% year to date. And VGIT, as much as we were banging on it, whether it's the right decision or not, that's up 3%. And my money markets, like yours, are up over 4%. And so it's a good reminder that we have a portfolio with diversity for reasons. But I imagine this is maybe a little more emotional and not just logical for you, because, like you said, this is so much newer, and you're looking at making some pretty substantial changes to income. Laura has stopped working, your spouse, and you are ramping down your business. So where do you land on how you feel?
Yeah, well, like you, I mean, I look at my portfolio probably a lot more than you do.
And that's
I don't do it just once a month, because I am still earning a little bit, and we're making this big transition point. So I'm trying to gain some comfort with that. I think during that last episode that we released, where we talked about our asset allocation, my allocation is basically 70-30 equities to fixed income. Same. And there is a 5% cash allocation in there. So it's 70, 25, 5, 25% in bonds. And you and I talked a lot about having some short-term bonds as part of that portfolio. And I said in that episode that, I personally would have taken on more risk. I'd be more of an 80-20 guy or a 90-10 guy, like a barbell strategy kind of thing. Right. And you said, well, why aren't you? Because your business is still earning cash. And I said, well, I have a partner next to me who's equally invested, and she says she's not comfortable with that kind of level of risk and the volatility that comes with that. And I got to say, right now, I am pretty happy with that portfolio. Just checking in with it. So when things started taking a turn south, I looked at it. I hesitated looking at it, and I thought, oh, well, that's it's significant, but it's like, it's not as bad as I thought.
Yes.
And so, yeah, I just checked in with it again today, and, you know, we're above our fire number. I'm glad to have built a buffer
awesome.
in there. Setting a conservative FI number, there's a lot of value in that. So, you know, to your friend's point, I think if you're not sacrificing much to make the one more year work, and it satisfies both the needs of both spouses, you know,
Yes.
it's like, that makes a lot of sense. I also, you know, we've been using Monarch Money to just kind of track for expense tracking more than anything. And it's nice to just see, you know, we've kept our fixed expenses, I think, relatively low and under control. We own our own home, so we don't have any debt, which is, you know, a privileged place to be in. But our discretionary spend is pretty high. That's like the bulk of our budget, I would say.
You've been traveling a lot.
Traveling a lot, and that feels great. And also just knowing, you know, like if we had to cut something back because things were going south, you know, there's a lot of discretionary room to do that. So I think, you know, to your point about building a plan, you know, that you're comfortable with and one that you know is going to work is really important there.
It is.
Yeah.
You know, this is a good time to remind people, because we got a lot of questions that could have been answered by the show notes. Check the description. Whether you're on the podcast or whether you're on video, there's a link to the show notes. It's very logical and straightforward. We have covered some of this content before about asset allocation and your feelings about going into bonds and how that's changed over time. We can't cover this in like a 30 or 40 minute episode. It's too big. And I think the context of the historical changes and consistency and how we've thought is actually really informative. I get a lot out of going back and listening to what our conversation was about in my first year of retirement versus where you were about asset allocation. And so I would just point people to that, because so often I think some of the questions that come up, and they're very natural questions, are answered by some of those old episodes.
Yeah. And, you know, there's a lot of talk about strategic asset allocation. And I think a lot of these questions, you know, and if I think back to that last episode, you know, why didn't you spend your cash down at that point? It's really the answer is because you have a strategic asset allocation that you always stick to. It's 75, 25, 5. So you're always going to have 5% cash, and whatever it takes to make that happen on your rebalancing schedule and when you want to refill that cash bucket, that's why you do that. And I think there's a lot of value in people actually listening to that again, because sometimes it takes me a few times to hear you say that, kind of hammer that home. And I know Karsten, when we had Karsten on to talk about, you know, he was sort of fighting with Fritz from the Retirement Manifesto about the bucket strategy versus strategic asset allocation. Really, I think you and I both fall into this strategic asset allocation. And, you know, also to the point of people asking, well, why aren't you considering tips and, you know, commodities and other diversifying assets? And, you know, you and I have always said we're bogleheads. We do have a broadly diversified portfolio. You know, I have international equities just like you do. I have U.S. equities, the dominant position in U.S. equities, but they're all index funds. You know, I have a bond position, and I've been rotating into treasuries because my rules-based strategy that I set up the last time that we talked about, I've been triggering those rules, and it just happens automatically now. And so I've been reducing my sort of short-term cash position to make that happen. So I think what we're both saying is there's a lot of comfort in the plan that we developed, and you know, having those kind of things in place is really what's keeping, you know, it helps you sleep at night, right? It
does. Well, and I 2 points come to mind, and the first one is that above all, despite all the whinging and over-optimizing that people with a fire mindset, we're just naturally prone to do. I was talking with somebody about that on Discord recently. There is not a right plan. I mean, sure, mathematically, something in retrospect will have been an optimal decision path, but you don't get to know that. That's how it works. But what study after study has shown, and people like Ben Felix rightfully harp on this all the time, is that consistency is probably the most important thing. Not just taking big emotional decisions that everybody thinks they're immune to, right? It's the old Tyson, you know, everybody has a plan until they get punched in the face, right? But sticking to those, not letting emotion rule the day. And the other sure thing is keeping fees as low as you can is a sure path to reducing that mathematical draw on your portfolio. You and I are not here to debate the merits of gold or other precious metals, and not because, you know what? It's like anything anything these days. People have done their homework and they don't want to talk about it. And that's cool. We don't have allocations in those alternatives, and that's fine. Some people do. I think it's great. I hope they're consistent about it and they're not constantly moving in and out of gold and other things, because that's likely to have more of a detrimental effect. The other thing that comes to mind that I think you hit the nail on the head is this idea that there are things in a conservative kind of standpoint about thinking about our FIRE numbers that really do give you comfort. And one of those I found was the way, and maybe this is the time to bring it up, the safe withdrawal rate idea. No matter what strategy you follow, there's something in there building in a buffer. For me, and I know for you as well, we're using a CAPE-adjusted safe withdrawal rate using Big Earn's safe withdrawal rate toolbox. And for me, I looked at year-to-date, what am I actually withdrawing versus in aggregate, what I could withdraw. And I've talked before about wanting to stay below that and use it as a ceiling. So the ceiling right now is about 4.3%. In aggregate for year to date, and I'm at about 3.6. So I'm only at about 80% of my maximal spend. And that feels good to me, because when stuff does come up, I'm not worried that, I'm taking out cash in the worst time possible and I'm going to have to sell more at the next time, or I'm going to have to think about, do I draw down my cash more than my IPS says I should? And so, at least for me, I get a lot of comfort looking at that number every month saying, I went over this month, but I've been below the last 3. So that feels good. I mean, you probably haven't had too much experience with that yet, but...
Well, no, honestly, I use that as a check-in, and it's one of the reasons why I'm doing the expense tracking, so I can see how that fits into the ceiling spend.
Yes.
Are you using a 0% failure rate?
So I'm just using the CAPE adjusted tab.
Literally just that tab.
Literally just that tab. And so every month it says your portfolio is this, the CAPE is this, therefore you can take out this.
Yeah.
And that's going to swing over time, but to date it hasn't moved very much at all, and not in a material way, because we built our budget to stay below the ceiling.
Yeah. Have you also gone back into the sort of main parameters tab and looked at some of those, the fail-safe rates?
Honestly, I had meant to do that at the end of the year, and I didn't do it.
Yeah.
So maybe now that's an exercise I should do and see if I should be more worried than I am.
I mean, just check in with it. It's interesting because, and especially in the I look at both of those tabs. I mean, I ascribe to the CAPE adjusted withdrawal rate. And obviously, you and I are a little bit different places with this because the business income right now supports us. So we're not really drawing on the portfolio, but I'm using it as a metric to track. And, if I look at my current portfolio and in terms of just the main parameters and results, the fail-safe rate is it's still over 4%, whereas the CAPE adjusted rate is slightly higher. It's interesting to look at those two things and then and really kind of dig into some of the charts because if you look at when the S&P is down between 0 and 10%, like it is right now, it's giving you different rates, safe consumption rates. And so it's just nice to have that context of just knowing the market is corrected here, valuations are still fairly frothy, I would say, historically, but it does set it in context of where your portfolio is in time. And so you check in with that at the end of every or beginning of every month. Right?
I do, and I think it's more of a tracking and confidence exercise. It hasn't had to cause me to do anything materially different because our budget, is meant to be below that. But at some point, it could get a lot closer than it is now, depending on what happens in the market.
Yeah.
And so you say you're checking your expenses against it. So you're treating it like if I were withdrawing, how are we doing relative to what it says I could withdraw?
Exactly. Yeah. And I really like the tool. And the hard part I have is, when I show it to Laura, it's kind of a little bit of a head spinner if you're not used to looking at it.
Oh, yeah. When you look at it,
it
looks like that.
I feel like it's not the best tool to use.
It's not the friendliest tool.
It's not the friendliest tool. Yes,
but once you get it right, don't you think it's really easy now?
It's very easy. Yeah. And actually, have you gone in and played at all with Social Security?
I have.
You have. So
yeah.
I mean, it makes a pretty big difference, actually.
Oh, it does. And I are you still doing the same thing? I use 50%. I model 50% of my allocation or my projected.
That's pretty conservative. I do 75%.
Oh, I know it is. I do it on purpose. It's more buffers on buffers. I know. I'm sorry. Guilty again.
Yeah, but in any case, don't ignore that.
Definitely
if you
not.
are eligible for Social Security, don't ignore that, because what you're doing is you're crimping your spend in a pretty significant way. Actually, I modeled it a couple of different ways just to see the effect of it, and obviously you can change when you when you start drawing on it. And model those scenarios out too. I typically prefer Projection Lab for that stuff.
I was going to say that it's a way better place to do it.
It's a better place to do it, but it doesn't have a CAPE adjusted withdrawal module in there. So I want both things, and I don't love the withdrawal piece on Projection Lab as much as I like the Karsten's tool. But it does bring up another question, Jay. We're living with a certain budget right now, and inflation is a real issue. How do you think about this? There's the specific categories that I've noticed hit hardest are like healthcare, insurance, travel, food. Have you thought about this at all, and how it's going to impact your budget? Do you plan in Karsten's sheet more than 2% annual inflation rate?
I don't. I do have higher in Projection Lab though. So that's out of sync with each other. Okay. But it's the right question to ask. It's also this sort of unknowable quantity like anything. So I think conservatism is probably very warranted. I do think about our actual budget at the end of the year versus our actual spending. And I have increased it several times, some of which we've talked about here on the show, because I realize that, look, groceries have gone up. Some travel expenses like airfare have gone up substantially.
Yeah.
Yeah, and it really hasn't recovered since COVID. And I always wonder, like everybody, how much of that is profit taking, how much of that is here forever, because for some reason the major grocery store chains around here, egg prices remain inflated, but Trader Joe's are back down. So
they're down around here. But
I don't really know why that is. That's a California thing, just taking advantage of people. It doesn't feel good, but anyway, inflation at the grocery store is a real thing. I do the food shopping for the family. I see how that bill has changed over time, and And
eating out. Laura and I
restaurants, forget it.
We just went to a show in Boston this past weekend. $16 for a pint of beer, $45 for a concert T-shirt, $85 for a hoodie. I wasn't buying merch there, and I know this is how bands support themselves. There's a lot of other factors in here, but my God, $16 for a pint. I was like, what?
and it's a thing.
It's a thing, yeah, and it just doesn't seem to be going down ever. The airfare for the trip that I took getting over to Scotland was $1,200 for me to get across the Atlantic. I was like, what?
Yeah, it's not even a long flight for you.
It's not a long flight. It was crazy. We just re-upped our home insurance, and this is something for people to flag themselves. With valuations going through the roof the past couple of years, we were like underinsured. I looked at the policy. I was like, oh, we gotta bump this up, and that was. Our policy went up like 60%.
Yeah.
That's not small, and our auto policy, that went up. And granted, I have a 19 and a 21-year-old driving their own cars on that. But, all of these things in aggregate, like that's cause for concern here, and reason to add buffers to your budget.
I think so too, because, some of these things, I think you can't. Oh, maybe somebody out there is way better at this than we are. And that's probably true, right? Some people just love this stuff. Projecting future growth of expenses, they're not all linear, right? Electronics, right? They get less expensive. College continues to soar for reasons that have been talked about by people much smarter than me. I still don't know why that is, besides greed. But anyhow,
health insurance,
price of housing, etc. And so you can put assumptions on this stuff, but you can't get it. You'll never be correct about everything. And so I think this is where having some flex in your plan is probably a really smart thing. And it's something obviously both of us have tried to do, but it doesn't
also a higher equity position. You can't just, it makes me want more equities in my portfolio. So,
and this is the trick for people on a fire path. Unless you do a substantial amount of overaccumulation, most of us need to carry, whether it's 60, 70, 80% equities to mathematically get there. And so that does mean risk, but it also means the ability to be compensated for that risk.
Yep, volatility.
I think it's also another reason why we get questions all the time from people about, can you recommend a fee-only financial advisor? We've put some links out there before. I'll probably stick them in this episode again now that I've mentioned them in the show notes. But ideally, you want to be talking to not just somebody who's qualified, like a CFA, CFP, for example, but somebody who's also familiar with kind of FIRE duration retirement, because a lot of the questions and the considerations are different, and not everybody is as familiar with them as much as the math should still work either way. So I know you and I both ran into that a little bit in some of the folks we spoke with.
Yeah, for sure. Yeah. So has this changed how you're living your life right now at all, this downturn?
It really hasn't. It's not materially changed it. We're not spending differently. I would say when I think about the aggregate cost of like a big expense, like a trip, for example,
yep,
it gives me a little more pause. I'm like, all right, we've spent a lot of our travel budget. How good am I going to feel about going over if we decide we want to versus how I would have felt a year ago? That's a very different thing. So I think that's fair. How about you?
Well, it's funny I found myself when I got to the end of a trip thinking, oh, geez, I've spent a lot here. Do I need that? Do I need, the cherry on top of the cherry on top of the
I saw some of that.
Of the cherry? Yeah?
Yeah, we talked about it just buying wine. Remember? You were like,
did we really?
Yeah. I was buying the like 20 euro French wine, and you were like pushing for the, 8 euro Spanish wine.
Well,
and
I feel like that was the end of the night, man.
You were like, we're spending a lot, man. Like, you got to think about this. And I was like, oh, that's interesting, because you were one of the people, I remember way back when we were still early in our careers, you were telling me how much you spend on your grocery bill, and I was like, what? And you were like, it was so much more than us. And I'm not saying it was wrong, but it surprised me. And you were like, well, you should really enjoy the meals you're making. Like, and it's the same kind of thing. It's like, there's decisions we have to take. We would just want to be eyes wide open about them, make sure they fit. Our preferences fit with the budget we put together.
Well, I thought we bought like one nice bottle and one shit bottle.
We usually did. But I mean, you may not remember, we did talk about it.
Okay.
And we also talked about, I think, towards the end of the trip, about like where we were going to go out to eat. Like, we don't really need like something nicer, like just low key. We've spent a lot of money on this trip.
Oh, okay.
And like someone who travels, and I think very nicely, like you've done some really nice trips. You've shared some of the expenses you've incurred with some of your family trips, like for that housing.
Oh, yeah.
Right. I know Lori and I were both like, whoa, that's a lot. But it's also like, it's cool because it shows where you're prioritizing making those memories with your family, et cetera.
Totally. Yeah.
But that's why I say it was interesting to hear you kind of evaluating like, oh, we are spending a lot. Maybe we could be a little more thoughtful. And I was wondering, is that a reflection of, all your life changes? Is it a reflection of what the market is doing right now? I mean, what do you think about that?
I mean, I guess for me, the switching gears between saving and spending feels very different. And I know, a lot of people told me that it would feel different. And I was like, maybe not. It really does feel different to consume everything that you're earning. And I was so used to saving. And I was saying that to Laura this morning. I was like, geez, we got some income from the business. I was like, I got to save this. I was like, no, it's not really the rule set that we have right now. And so I think I'm still programmed to think about things in a certain way. But I really do feel strongly about prioritizing travel and, hotel stays. Like, we stayed in an amazing place the last night we were in Edinburgh. And like, I mean, I could do that 320 nights a year. Like and I feel like it would be money well spent. And so there are certain things that I'm really into, but if we get one good bottle of wine and like one that's like so, I'm fine with that, like that kind of balance. But you're right. It does, it shows up in different ways. I think now that Laura's no longer working, we don't have that. We're paying for health insurance through the business. It's like a lot of things have changed here, but I do feel like, I do have more comfort now with this idea of like what retirement is starting to look like for me. It's not really that much work anymore.
That's awesome.
We settled into a schedule that's like, there's some work in the morning because I kind of like that. That feels good to me. There's like hiking in the middle of the day for a few hours. And there's projects that I'm working on for the house. I'm, redoing some stuff at the house, things that were neglected when I was just really hitting it hard. Like I think a lot of people do. Writing, photography, there's like a lot of things to fit into the life. And at the end of the day, like Laura and I will reconnect. She's off doing her own thing. She's not really working for the business. She does a few things here and there, but it's not like a 10 to 20 hour a week, I think, like we had initially talked about. But it feels so great. I was saying when we came back from this show that we went to in Boston this weekend, like we could have spent another night there. We didn't have work to come back to. The freedom and then flexibility that we had, there's no pressure. There's none of that weight on our shoulders. That responsibility of like having to earn another dollar is just gone now. And it's freeing. It's just so awesome.
It is. And I'm so glad to hear that, and honestly glad to hear it relatively early, I think, in your transition here, which is really cool. We talked about it a number of times in early episodes of the show. It took me a while. I found I was over scrutinizing expenses, and I was just being too intense about some of the budgetary stuff. And it took me a while to sort of mentally start to let go of that. Even if operatively I wasn't really doing anything different, the sort of oversight and the kind of intensity of that changed a lot over that first year. And then it's only become more comfortable. And so I think it's an honest reflection of how I feel these days, that while I have a lot of concerns, kind of bigger picture about the world today and our place in it, that my personal finances are not at the heart of that. And that feels like a very good thing, because it's nice to know that stuff is taken care of. I don't have to worry about the family and our son's school, the cost of that, keeping the lights on here. It feels pretty good to not worry about that. And that's a privileged place to be. We worked hard to get there, but nonetheless, I feel very confident about that. And that's
I don't feel like, you mentioned this before, the transition that I've had with, running my own business and entrepreneurship, and, it's different than yours. It's different than the paycheck shutting off and you immediately, stepping into drawing from the portfolio. So I don't want to, sugarcoat it and make it sound like, I'm not paying attention to the portfolio and looking at the budget. It's the reason we're doing expense tracking. It's like, okay, I want to have my hands in this a little bit. I want to control the bond position. I want to, I want to optimize and get things right. That's definitely who I am. But, for example, on this whole tariff regime is going to probably kill one of my side businesses that I have, because it's a physical products business, and it's heavily impacted by this chaos that's happening right now. And, I'm disappointed by that, but it's not blowing up the plan, because I had a diversified set of revenue. It's just this whole time is just telling me, and hopefully people are taking this lesson from it. You need to diversify, in your portfolio, in your revenue, just in life in general. You can't rely on one set of rules to make it all work, or one allocation.
That's right.
To survive this. And I think, this is definitely a sequence of return risk moment. And designing a plan that has cash buffers, conservative withdrawal rates, flexibility baked in, if that's possible, an asset allocation that makes sense for your time horizons when you're going to be needing that cash, and accepting that, downturns are a natural part of this market. Like you and I both knew that inflation was going to show up. We knew volatility was going to show up. Political chaos is probably going to happen. This won't be the last political chaos we'll ever see in our lives.
It is not.
But we have a plan that's like weathering it, and that feels good to me.
Yes, absolutely. I think you said a lot of really smart things there. I would add to one of them and just say that it's very easy to get caught up in this time is different, especially for the younger folks who haven't lived through some of this turmoil before. And I don't mean to belittle that idea. I'm not belittling you or that sentiment, but just know that the longer we live, the more of this we experience. And while it doesn't feel good when it happens, nor should it, in my opinion, you're going to get through this. And, we're appreciative of your support, and in turn, we hope the best for all of you. We're going to get through this, and when you have a good plan, as I've said before, you still have a good plan when things go south. Yes, some of your assumptions have changed, and some of your timing in some cases may unfortunately change. But I think there are so many people watching this who, from their comments, I know they're doing the right things and they're being really smart, and many of them are being much smarter and more diligent at earlier ages than you or I were. So that's commendable. It's going to serve them well. And I look forward to hearing their stories of success, because they're going to get there too.
I did want to say, it was well said, Jay, but I did also want to add, for the people who are kind of on the cusp of, reaching their fire number, and they just saw, 10, 12% shaved off their portfolio, that I know what that feels like. It's such an awful feeling because you worked so hard to get there. But, the law of large numbers suggests that, when you get moves like that, your portfolio is going to move quite a lot. And, the rebounds in the market tend to happen pretty quickly. So I remember feeling all of these feelings back in 2022, and just knowing and hearing from Karsten, we had him on the show at that time, and I was asking him about my asset allocation, and he's like, you'll probably be fine. You're going for 2024. You'll probably be fine by then, And I was like, oh, I almost didn't want to hear it, because I was just so kind of depressed about being so close to the finish line, and then just feeling like I was slipping farther and farther away. So it can be hard to hear this. Stick to the plan. It'll be fine. You're all good. I
get it.
But also just like that advice to zoom out and look at the, Go look at the charts of the markets and how they move. They move in big ways, and so it is still possible, even if it means you may have to delay it a little bit longer. But just appreciate everyone's support, and hopefully we'll continue to do this on a more regular basis.
Yeah, absolutely. It's been great catching up. I hope you found the conversation valuable. I sure know I did. And everyone out there, be well and keep buying. These fire sale prices some days.
Buy high, sell low.
What?
Bro. All right.
Talk to you later.
All right. Bye-bye.
Bye.